Hey listeners, it's Dan here. I want to tell you about a company that I'm really excited about. It's called Current. It's a fintech company that's completely disrupting traditional banking. I'm a new Current customer, and it's already helping me and my entire family manage our finances, all from one easy-to-use app. So try Current for yourself and get the app by going to current.com/OK. That's current.com/OK. Current is a financial technology company, not a bank. Banking services provided by and Visa debit card issued by Choice Financial Group, member FDIC, pursuant to a license from Visa USA Inc., and can be used everywhere Visa debit cards are accepted. Welcome to OK Computer. I'm Dan Nathan. I'm here with Dan Benton, who runs Benton Capital Management. That is a family office. He was also the founder and CEO of Andor Capital in 2001 to 2016, which was one of the best performing tech hedge funds of its time. I knew Dan only by reputation back then. Now he slums it with me a little bit as we've just gotten a bit older. Dan, welcome back to OK Computer.
Thank you very much for having me.
Well, listen, you and I had a great conversation. It was back in the last week of April. It was right before, I guess it was going to be that deluge of big cap tech earnings, okay? And what was really interesting about that is that, the stock market was making highs the first week of January, all-time highs, okay? And so a lot of people really didn't want to believe that the Fed, when they said in late November that they were going to start raising interest rates to kind of battle inflation, that they were going to do what they said they were going to do, right? And it seemed to be a little bit of a delayed reaction from mega cap tech land. But we saw a lot of those kind of high valuation, more speculative sort of stuff in tech, SPACs, recent IPOs, crypto, all started careening lower.
That started in the middle of
2021. Yeah. Right. And I guess what was interesting to me, we always knew that these top 6 or 7 names made up 40% of the NASDAQ 100 and about 25% of the S&P 500, and everyone's waiting for them to crack, right? And so you and I had this conversation. I think a lot of our listeners also know that back when you were at Goldman Sachs and you were a big-time technology analyst, this was in the 90s, you came up with these 20 rules for tech investing, all right? So I'm just setting the stage here. And a couple weeks ago, we had Porter Collins on the tape with myself, Danny Moses, Guy Adami, and Vinny, and he said, a couple weeks ago, Dan, you had the illustrious Dan Benton on your podcast, and why are you buying tech stocks here when his 20 rules clearly don't line up with buying them here? All right, so that's the backdrop. Dan, welcome.
Thank you.
So after this Q3 earnings period, we had Amazon gap down, we had Microsoft gap down, we had Facebook gap down, right? We had Alphabet gap down. I mean, these were massive gaps, right? Like multiple day moves. So I started buying some of these stocks, okay? So that's when Porter pushes back and says, Dan, why are you buying these things? So talk to me a little bit. You've seen lots of tech cycles here, okay? How did the culmination of these stocks finally missing, guiding down, and investors wholesale selling? How did that feel to you, just thinking about it as like one thing?
It felt like it was the second or third inning. And look, I have, throughout my career, done a much better job at calling tops than bottoms. I'm always late getting back in. At a top, you see the market shows you. It gets narrower and narrower and narrower. And we saw that back in 2007, fourth quarter of 2007. I mean, that was Jim Cramer's Four Horsemen. So if you look back at the fourth quarter of 2007, Jim Cramer's Four Horsemen year, RIM, Apple, Google, and Amazon. Yeah. They were kind of the only things that worked in the fourth quarter of that year. We lost everything in our portfolio outside of those names, in the second quarter, the third quarter of 2007. So by the time you got to the fourth quarter, it's like this very small percentage of our portfolio is working, and then you're just tuned into, you get this negative data points that started in January of 2008, and you're just ready to pull. You're ready to pull the ripcord. And that's what we did. We bailed and frankly got the portfolio net short, but that's a whole other story. I don't find, and look, you're going to go over the top, right? But you can over the top by 10, 20%. You're not going to go down with it fighting. And, the first rule is sell technology stocks when estimates are going down. That's when we really started seeing estimates going down, was, kind of obviously ahead of the financial crisis, but that's what led to the financial crisis. So, So where are we now? We've just started cutting numbers. Now, back to the, what were the early warning things, to your point before, SPACs, companies without revenues, companies without earnings, fancy software names that I don't really even know what they do, but they were trading on, some metric that wasn't earnings or cash flow. Those disappeared really starting in the second half of 2001. Every new IPO broke price, some by a lot. So we had that backdrop going in, and yet, you're right. I mean, the top, the FANG stocks, throw Microsoft in there, were still doing very well. They didn't miss numbers. They were fine. Now you're seeing now Amazon, I think, had estimate cuts before, but we're really seeing, early rounds of estimate cuts, at least with Apple and at least with Google. So my glib answer to when you start buying is you buy after the last estimate cut. Unfortunately, you only know when.
No one will ring the bell down
It's
there.
like NBER, telling you that, the recession started 3 quarters ago because we changed our numbers.
So second or third inning, and so again, if we kind of go back, just a few months here, at the time, we're saying that we're seeing so much devastation that the bulls would point to it and say, maybe it's different this time. Maybe these 5 stocks have these tremendous moats and managements and monopolies, right? And they're going to be able to weather this much better, let's say, than some of these companies, like you said, that were losing money, that were reliant on the debt markets and in a rising interest rate environment, that sort of thing. And so I guess that was kind of the narrative back then. And just to be clear, I didn't find any of these major mega moats, if you want to call them, that interesting then, because all of them were trading at multiples. Apple was trading at 28 times, for expected earnings and sales growth next year of, let's say, mid-single digits with flat margins, right? And again, not even anticipating the fact that demand might come in during a weaker environment. And we're not talking about supply chains. We're not talking about inflation at that point. So to me, that was kind of the narrative for me across all of those massive names here. But here we are now. We just had the first cuts, and even Apple couldn't even get themselves to materially guide lower. They had to wait 2 weeks for a headline about some COVID lockdown in China to do it. So what does that tell you about the kind of mentality of these massive managers? And again, we're going to go through it. I mean, Amazon just announced today 10,000 layoffs, right? We're seeing Google basically halted hiring, will be firing. We saw Meta last week, 11,000. I mean, the list is going to keep on going here. So second or third inning, even for these big guys.
What's unemployment? 3.7%? Yeah. I mean, it's hard to think that we're anywhere near the bottom when we need to push. Unfortunately, we need to. The Fed's job right now is to push unemployment up, and guess what? We are now seeing layoffs at the most resistant companies in our economy. Well, let's see what happens in the rest.
But the pull forward, I mean, can you think about it if you're going to look at like the hiring of 2020 and 2021 versus the firing in 2022 that'll likely bleed into 2023, and you're still going to be above those kind of 2020 mid-year numbers once they're done cutting. So they're taking off some of the excess. It looks like the housing market. It looks like commodities. It looks like all that stuff that massively overshot its mean reversion, but it might still stay on that kind of uptrend, if you will.
So my comment, which has been quoted back to me, so I even kind of forgot I said it, was there are no cheap technology stocks. There are only wrong estimates, and let's see. Yeah. And to your point, that goes through the entire economy. This isn't just tech. The other thing that's interesting is that every one of those companies you're talking about is way past their peak revenue growth rates. We're talking about, about 20% maximum growth companies, single digits for some companies. And didn't Amazon have down e-commerce sales? I think that's right. Apple doesn't grow. How can Apple keep growing quickly? I mean, they're so big, and the cell phone market doesn't grow. So there are other businesses that can, but it's hard to move a company with that. That revenue
and to your point, I think this is the one thing that kind of spooked investors, whether it be AWS, Azure, Microsoft, or Google Cloud, is that you're decelerating growth in those kind of core growth engines when there are other businesses that are a lot more mature.
Right. So, so these companies went from, rapid growth companies to GARP companies, frankly, but then it didn't. Then, during the course of this period with rates of zero for so long, I don't know how you define the reasonable price part of GARP. Apple trading at close to 30 times earnings, not growing very quickly, and that's the correction. So you're right. We've had a massive valuation correction. We still haven't seen the numbers go down. Tech is an interesting animal. Cyclicals are supposed to trade at trough multiples at peak earnings. Tech trades at peak multiples on peak earnings because there's some, idea that these are making secular changes. It's not a cyclical. These are secular stories so that when things look great, they're just going to get better.
It's funny, you mentioned the unemployment and the thing that the Fed is trying to do. And they're clearly, over the course of 2023 with basically Fed funds going from 0 to about 4%. So we had 4 consecutive 75 basis point hikes expected in December to be 50 basis points. That's what the CME FedWatch tracker is suggesting. And then listen, if they do their job well enough, that means that they put the economy in a place that's much slower than where it was at the start of this year. And then you're going to see the expectations for rate hikes in 2023 just kind of fall off the map a little bit, right? And so I kind of feel like we've gotten, at least if you look at the way the 10-year U.S. Treasury yield acted on that softer than expected CPI number, and when I say softer than expected, mildly softer that we saw last week, you saw the 10-year yield drop 30 basis points in a straight line, which you've been doing this a long time. That was like an insane move. Unprecedented, right? So I guess I'm willing to say, and I'm not some brilliant macro mind, I'm just some kind of bozo who talks all the time about this sort of stuff confidently, okay? I think that we probably have seen the peak in yield for this cycle. That's my bet, okay? And so maybe there's a scenario that's kind of softer than the worst case scenario as far as a landing, is that if the Fed is now trying to bring inflation back to first mid-single digits and then low single digits. Remember pre-pandemic, their target on the upside was 2% inflation, okay? And let's just say that if major employers, some of these big tech companies, take off some of the excess of the last couple of years, maybe unemployment doesn't really get meaningfully above 4 or 4.5% or something. And maybe that would constitute a soft landing. And then we get back to these major tech companies doing what they do, which is very deflationary.
What tech companies do is very deflationary. If we, on a global basis, are reversing Tom Friedman's the world is flat. If we are onshoring, which is a terrible word.
Yep. Reshoring, can we say reshoring?
Friend-shoring, whatever it is, right? I mean, it's unbelievably inefficient. And it's going to, drive – it's inefficient from a productivity perspective. It also means we're going to be building a lot of stuff. So, I'm not a commodity expert, but one would think there'll be an underlying bid there.
Just, you mentioned that in our April pod. You just said that a lot of the stuff that would really benefit from deglobalization. It was really, and that's something that stuck with me. Some really good macro minds have been saying that. And again, we know that the disruption of the supply chains globally and how our tech companies, at least from a manufacturing standpoint, are so oriented with China, that was already put in motion from the trade war in 17, 18, during the Trump administration. So again, it just became abundantly clear that U.S. multinationals have to kind of rethink the focus on Chinese labor and the way that their supply chains are oriented. So your point is that if a lot of that manufacturing is going to come back to the West, and hopefully it would come back to the U.S., those are good jobs. It really is that, listen, talk to anybody who had a cat tractor dealership or whatever. When Amazon was building all of those, go on any highway in America and you see those huge warehouses, right? Yeah. That was good for the local, if you were in manufacturing or, heavy moving or equipment or anything like that. So it was good. So is this?
I think we also need to think about what parts of tech are deflationary. Electric cars aren't necessarily deflationary. The latest iPhone probably costs more than the last iPhone. You're getting better price performance, right? But it doesn't mean your price is going down. It just means you may get a product that, in the case of phones, probably 10% better. But in general, you're trying your new generation. You want it to be, 50% better or 100% better than the last generation. Doesn't mean you're taking the price down. when we think about, and we may have talked about this last, think about something like cloud. I don't know what percentage of the workloads out there are on clouds, on some sort of managed cloud. I have to believe it is minuscule. What percent of the government do you think
is tiny? This is a multi-decade sort of thing.
It's a multi-decade secular theme. So, and the beauties of secular themes is that they're not economically sensitive. They're interest rate sensitive. Interest rates go down, you put a higher valuation on a secular theme. They're supposed to grow throughout them. So one of the interesting premises that we're talking about, I don't know what Netflix's long-term growth, what's advertising growth rate at Meta going to look like, or at Google? These companies are now the industry. So they're going to look a hell of a lot more cyclical than secular. They have businesses inside them that are secular.
That's a great point. If you think about Amazon, they've had this ad business that's been growing really fast. It's over $30 billion a year. And again, you could say that they were benefiting from a secular shift to digital ads. They're a huge retailer, right? And so a lot of these consumer package companies are advertising on there. You see that growth decelerate meaningfully. Investors who are looking at that and saying, well, we want to price this, or that helps us get to that valuation better. You start thinking about that a little differently. And then you think about AWS. And to your point, it's like, this is, the public cloud is a massive secular shift, but it's been going on now for a decade, right? And so market share gains by Amazon are going to look less aggressive as more competition comes in and they compete on price a little bit, right?
One of the most frustrating things is that there aren't any pure plays they're all, every important tech innovation, I'm exaggerating, that we see right now is part of a giant company. How do you play AI? You can't. It's hard to own. Google owns DeepMind. It's a great resource. You're going to own Google for DeepMind.
Well, let's talk about the interest rate thing, because you just mentioned that. Again, when you think about it, I think you said this in April. The most important, defining factor for stocks and valuations is interest rates. So here we are. Okay, we just talked about the pace in which the Fed has been raising interest rates. I know that there's a lot of people out there, at least investors or in the pundit class, who said, you've never seen anything like this, what we're seeing in inflation. The Fed can't stop. You think they're going to be done with Fed funds somewhere between, 4.5% and 5%. And that's where the futures are kind of looking at. But this is going to high single digits. What do you think the likelihood? I mean, I think you were probably started this year, you might have thought, okay, we can get back to the prior cycle's highs, which is in Fed funds, about 4%, that sort of thing. I'm just curious how you're thinking about it now. I think the calls for some of, these like high single digits, Fed funds, I think they're kind of going away a little bit, and maybe rightfully so. I don't know.
It's a fascinating area to focus on. For an extremely long period of time, we have had a low interest rate environment, and so you have an entire generation of investors who kind of, I don't know what this means. We've had an extremely low inflation environment. I don't remember the last time inflation was talked about as something important. I mean, it's a long time ago. And so what happens when all of a sudden we got 8% inflation? It's like, and it goes, 5, 6, 8, and we see what's going on with commodity prices. We have, the reshoring or whatever it is, as a secular theme. Oh, and we have a war in Ukraine that sounds pretty friggin' scary. This guy's threatening to use nuclear weapons. I mean, and you were, trying to come up with a coalition, and Europe had weak knees. I mean, they were all worried about not getting gas, and they're putting all these things in so that we're gonna do everything but this. It's kind of a terrible bargaining position, by the way, when you're fighting a war, to tell the opposite, tell the enemy what you're not willing to do. I think as we've rolled forward, I'm not an expert on global events. Ukraine has clearly seized the momentum. Putin is on his heels. There really isn't any sign right now of the West capitulating and saying, oh, no, we need to negotiate something. And so that inflationary fear, part of that inflationary fear, I think, has been dissipated. I really would like to see unemployment go up. I mean, I think one of the things that we are seeing, so we started out by essentially seeing commodity price inflation, right? We're seeing wage inflation. I mean, every not-for-profit I'm working with, when I look at the budgets, we're seeing wage inflation, 5-6%, cost of living increases. We just saw, an 8.3% Social Security, what was the number? I mean, staggering numbers.
Let's take a step back because this is really important. You said 5 or 6% wage gains when inflation's 8%. So it's still not that impactful.
So the only people that have seen this before are the people that were around in the 70s. Okay, and there was no threat of world war in the middle of that as well, frankly. But in the 70s, we had two massive oil shocks in 73 and 79. We had double-digit inflation, and as we all know, Volcker came in and raised rates into did they go to 21 or 18, whatever they went to, right? Immediately that's the playbook. Because there's nothing else to compare it with. It's not like the Fed hasn't been kind of warning that we're going to stop this. And if it keeps going up, we're going to keep raising until it stops. Yes, I do think the 10-year bear market that we had in the 70s, it doesn't feel like that's on the table right now, absent some exogenous shock.
It's funny. So to me, it just seems like you look at our lives, everything's been financialized, right? Everybody's got a stake in something that's financialized. And obviously, we've seen this huge boom for just with low interest rates, whether it was in housing, whether it be in just personal expenditures. We've seen, consumer credit go up at a time where, consumer savings were going down as a percentage of all that. But then the pandemic happened, right? And that kind of fixed the balance sheets of consumers to some degree. I guess the way I think about it is, I've been in the business for 25 years. And to your point, I don't ever remember inflation being a concern. I remember pre-pandemic actually deflation being a concern. I remember talking about universal basic income. These were things that politicians were kind of actually starting to kick the tires on here in the U.S., not in Iran, here. I'm like a big mean reversion guy, and I think we're going to see a lot of this stuff come back. And so when I think about the potential for what I think is a soft landing, and I think, anybody who's got to bug up their ass about the Fed and what they do and how it hurts savers and how it hurts middle class or lower class, well, you just said it. For the first time in a very long time, okay, wage earners on the lower end have gotten a raise. And so if the Fed is successful in cooling down the economy with these rate increases, and you could say normalizing rates, go back to 2018 in Jerome Powell's first year, he was on autopilot raising Fed funds 25 basis points. And what happened is when we got into Q4, we had a global growth scare, primarily like China. And then all of a sudden the stock market here went down 20% in a straight line and he stopped. And then what happened? The stock market took off. And I guess the scenario that I would say is that, again, back then we had unemployment below 4%. The Fed's balance sheet was much smaller than it was right now. So that was a better cocktail, I think, for, growth and returns on risk assets. And so I guess the question I would say is does all this debt, sovereign debt, weigh down potential for future growth? Maybe, though, this one component that you're mentioning is that if the worker here has more power all of a sudden, okay, because of reshoring, deglobalization, and then all of a sudden we have this huge movement where jobs are coming back here, could there be some sort of equilibrium where maybe there is a soft landing? Does that make some sense in a way? Because I don't know, man. Like right now, unless we have
doesn't it feel like demand for labor is going to outstrip supply? All the trends you're talking about,
and that's an immigration thing,
and that goes back to immigration,
right?
I mean, this is a thorny matter. Okay, so bottom line is, when do we buy them? This past July or August, we had a pretty big snapback rally, right? And then they set lower lows. That reminded me a lot of, and maybe that was off. Was that off the July earnings or something?
You know what it was? It was actually off of inflation readings. So what happened was in mid-June, we had a CPI reading that was slightly softer than expected, and the market was at the lows. Sentiment was really bad, and then we were getting into the end of Q2. We're going to get to Q2 earnings season,
and then the earnings came out and crushed the rally.
Yeah, and essentially, but we had rallied too far. We rallied almost 20% from kind of mid-June to kind of that late July
Bear
period.
market rallies are a bitch.
Yeah.
right? Because you don't want to get left behind.
Yeah.
And you really feel like,
it's a FOMO thing.
You feel like, I mean, it's when everyone's losing money together, well, misery loves company. I hate losing money. I'm losing less than this person. Fine. No one wants to lose money when the market's going up. And, so you're right. It's a FOMO thing.
So I think something that's changed, though, year over year from 2021 is that obviously last year was a great year. The stock market closed up 28%. Okay. So there was a lot of retail investors who actually, though, they were in all the crap, right? They were in the Roku and the Zoom and the SPACs and the this and that, whatever. They were already getting hurt. So come into this year, I think retail has been taken out. Throw crypto in there and it's like lights out. And so when I looked at what we saw last Thursday and Friday with nearly a 10% two-day rally in the NASDAQ, that was off of basically a low. It was basically off of a 52-week low. Sentiment couldn't have been worse. And so to me, that is not buyable. Like I wanted to be buying stocks the weeks after, like the week or so after earnings when everything felt horrible. I don't want to be buying them when everyone and their mother, and they're generally hedge funds, either covering shorts, right? And then people tripping over each other.
Buying ETFs or something just for exposure. So, we may have talked about this last time. When do companies have easy comps? Companies haven't had easy comps yet, right? When do the easy comps start? December is going to be a crappy quarter, and it was a strong quarter last year. March quarter, people didn't beat numbers that much in March, right? And by June, people missed numbers. So we know that June of 2023 are easy comps. We know that companies will look like they are accelerating, and it's ridiculous because you just divide. The denominator is small, but the growth rate seems higher, and people love acceleration. One of the things that the market has taught me in the last few crises is that it discounts things really quickly. I mean, COVID, for crying out loud, the market spiked down and spiked right back up in 6 weeks. The market discounts really quickly because there is a lot of money that doesn't want to miss. And in that case, we were investors who bought the COVID dip, if you will, made a lot of money in 2000. So I want to get back positioned in the market 3 months, 6 months before the numbers look like they're accelerating. And what I said to you before is you want to buy, you want to buy the last estimate cut. The problem is you only know what the last estimate cut was in hindsight.
How long would you expect? Let's just say that this was the first material estimate cut for like those major tech names, okay? And again, analysts have been lowering their estimates like low single digits, you know what I mean? And just a little bit on the margins here, right? And so the company's finally guided down. And that was to me the first step in acknowledging you have a problem, admitting you have a problem, right? And it's not that they have a problem. It's just like they're coming out to the street who they have not had to guide down since it was the throes of the pandemic back in that period in 2020. And everybody was given a mulligan back then, right? And so now they're actually saying, okay, we're going to actually have to cut costs here. We're seeing lower demand. The demand thing, and especially in the enterprise, it's not something we had heard until I think late July, maybe August, that demand was weakening. And to you and I, if unemployment's going up and the way that we've seen this secular shift towards SaaS sort of products, it just makes sense. Then you're going to see lower licenses for seats. You're going to see lower demand for cloud services, all that sort of thing. So to me, that's really important. So I guess my question is, how many quarters? I say this on CNBC or this podcast all the time. These are not one quarter events. Like they're just not, right? And so usually when you have a company miss and guide down, they're going to do it again.
That's one of the rules.
Okay, so that's one of the rules.
Problem. No such thing as a one quarter problem. Right. And when everybody in the industry has a one quarter problem, that's called an industry slowdown, right? So in my experience with, I love doing earnings models because you made your money when you had the highest estimate on the street and they beat the numbers, or you made your money when you had the lowest estimate on the street and they fell short of your numbers. So my career, that was one of my major focuses was we need to model better than other people. And one of my frustrations with financial analysts is that they model things as a percentage of revenue. They don't model expenses as dollars. They manage expenses as a percentage of revenue. Companies can't control revenue. Revenue comes in where it comes in. I mean, you may have, companies that close a lot in the last week of the quarter, whatever it is, but revenue comes in where it comes in. expenses can be changed, which is why they're cutting costs now. But companies miss big time because they are growing expenses. Revenues miss massive margin compression. Analysts don't model that correctly because they think R&D is going to be 7% of revenues. Revenue comes down, R&D comes down. No, it doesn't. It keeps growing until they start firing people. Revenue comes down, G&A never comes down, right? But if you model as a percentage of revenue, you're never going to capture the margin compression, just like you're never going to capture for positive revenue surprise, you're never going to capture the margin expansion. I don't think. And that's a flaw in the way people model. I don't think that we have reached the stage yet where people are forecasting companies to be so bad that they'll come out better, right? That the actual numbers will come out better than people are modeling.
So you used the example of 2000, 2001, 2002, and it was interesting because, the question is, when do you start buying? It really actually you have to decide first, when do you stop selling? Okay, because I remember, 2002 felt a lot worse than 2001, in my opinion. And there was still like some uncertainty whether we were in a real bear market, whether the bubble had popped. '02, it was definite. It was just a series of lower highs and lower lows. But then there was a point late in the year, and I think you probably remember this, and I think it was Yahoo's earnings. It was their Q3 earnings in October. The stock was low single digits. It was the poster child for the .com, kind of bubble, if you will. And it was like trading at cash. And every analyst hated it. You know what I mean? Like people were still talking about it being a zero. And when a stock is, 5 or 6, you can see it going to zero, right? And, they come out with a quarter, they miss, they guide down, but it wasn't as bad as everyone expected. And then that was it.
Rips, right?
And that was it.
And
it never looked back. And I'll tell you this, people tried to short it when it doubled, after 2 months, and you got killed, you got your face ripped off there. And then you started seeing that mentality move to other parts of the market. So not the things that were first hit or hardest hit, then you started seeing relative strength with some of these other sectors that have been left, for dead in value. And so that to me could be a good analog for what we see late this year into 2023. I'm just thoughts on that a little bit. Because we will discount, won't we discount, the recession?
We're going to discount 10 of the next 1 true turning points. Okay, it's what we saw back in June. Okay, it's what you saw in the last 2 days, and one of them will be right. So one of them will be that Yahoo thing that you remember, but the 6 things that were false signs, you forget them now, right? And so, one of them will be right. I just don't know when it is yet.
But is the macro really important right now? So like we just talked about, kind of inflation and interest rates. Think about this. Let's just say that we're kind of near the Fed being done with raising interest rates. We've already seen shipping rates rollover. We've seen a lot of industrial commodity prices roll over. You mentioned wages; those are going to be sticky. We've seen housing rollover, right? We've seen a lot of things kind of come back, towards that kind of mean, if you will, right? And so, I guess my point is like maybe there is a scenario though where we basically the macro does enough to kind of get us back to a place where these companies don't have to cut to the bone. You know what I mean? Like, I'm trying to be a little silver lining-ish here.
So the group that turned us in 2003 were semis, and the SOX I think was down 80% off the peak. I mean, it had just gotten crushed, and they were, and these are companies that sell physical things. There's nothing ephemeral about this. There's no clicks. There's no,
eyeballs and all that.
Yeah,
bullshit.
no, there's no, price to off balance sheet revenue or whatever the stuff that happens with cloud companies. And there was this massive glut of semis because everybody had built up all this internet infrastructure. PCs had gone bananas. Cell phones were going bananas. And, Nokia was a massive consumer, I remember back then. And, they had this massive amount of inventory. And it was if they buried, tens of millions of phones in the Sahara Desert or something in the summer of 2003. And they had a transition. I mean, people don't remember this back then, right? From black and white cell phones to color. and you got a little product cycle story in phones, and the whole semiconductor industry came roaring back. And that's an industry where you do see that massive margin expansion when that happens.
Because you have the fixed costs.
And it's another one where you had trough multiples on trough earnings.
Yeah.
So I tend to like to look at semis as an early indicator of things getting better.
If you're really focused on it right now, I mean, if you look at the SMH, for instance, it's up 35% in the last, I don't know, I want to call it a month or so. And that is pretty astounding. At its lows, it was down maybe 48, 49%. Sometimes it's hard to look at a group like that. Intel can't get out of its own way. AMD is still down, 55% or something like that. But a huge contributor to the weight of it is NVIDIA, which is going to report earnings this week. And I think that's going to be really an important one. That stock is up 55% off of its lows in that period. So it's driving a lot of that semi performance. So we'll look at semis because of the cyclical nature, because of basically the leverage that they do have. They'll kind of move first. I'm with you on that one. These big mega, cap companies, again, it'll be interesting to see if some of the cuts that they're making on the cost side give them the opportunity to not guide lower, maybe make some of the lowered estimates. Okay, so we won't know that until January. A lot of the SaaS stuff, to your point, I think that it seems like you got a little bug. That's a new wrinkle over the last 20 years that didn't exist, because it's generally a different model here. But how do you think about that? Because a lot of those companies, again, were trading 30, 40 times sales, many while they were still going lower. And those multiples they're getting to high single digits, now-ish, but they probably have to overshoot, don't they, to somewhere, mid to low single digits.
I have never made money in SaaS. I have never made money on the long side or the short side, so I just stopped participating. I'm good at stuff that you can touch. So I'm good at a device. I'm good at semiconductor. Interestingly, I've been good at internet-related things because they're more like different business models. Software and SaaS have package software, right? When Microsoft used to sell stuff in a carton, that was good.
Hey, Dan.
What up, guy?
You're into this fintech. What's all this I'm hearing about Current?
You're going to like this guy. Current is a fintech company that's completely disrupting traditional banking.
Wait a second. Does that mean I don't have to drive to the bank anymore?
Yeah, exactly. I'm a new Current customer, and I manage all of my finances from one easy-to-use app.
Well, I got to get this app, but where can I learn more?
It's super easy. Just go to current.com/OK, OKAY, and download the app. That's current.com/OK. Current is a financial technology company, not a bank. Banking services provided by and Visa debit card issued by Choice Financial Group, member FDIC, pursuant to a license from Visa USA Inc., and can be used everywhere Visa debit cards are accepted. Hey, it's Dan here. I'm excited to tell you about a $1 billion app that's disrupting the way people like you and me invest. It's called Masterworks. They offer investors access to an estimated $1.7 trillion alternative asset that was once only accessible by the ultra wealthy. I'm talking about blue chip art. Blue chip art has seen price appreciation that's outpaced the S&P 500 by 164% from 1995 to 2021. And the Wall Street Journal recently called it among the hottest markets on earth. It's no wonder the ultra-rich like Jeff Bezos recently sold tons of Amazon stock and bought more art. And now you can too with the art investment app called Masterworks.io. Join over 300,000 members for free on Masterworks.io. Just go to masterworks.art/OKComputer, OKAY. That's masterworks.art/OKComputer. See important disclosures at masterworks.io/disclaimer. Taboola uses AI to power recommendations for many of the world's top publishers and cell phone manufacturers. You know Taboola. If you ever went to websites like CNBC or USA Today, when you finish reading an article, it's that tricked out recommendation engine pointing you towards additional content you will like. They also help brands reach over 500 million daily users, which makes them a compelling alternative to Facebook and Google ad platforms. Taboola has long-term exclusive partnerships with publishers, which means they help people like you and me discover content outside of social media. Taboola is a founder-led company that is traded as TBLA on the NASDAQ. Find out more about their mission at taboola.com. Let's talk about Tesla really quickly before we get out of here, because we spent some time talking about Elon and Tesla. And, that week that you and I had our last pod, he had just made his bid for Twitter. Now, at that time, was it that day? Okay. So $44 billion. It didn't change. He bought it for $44 billion. He took about $13 billion in debt from these banks. And I got to tell you, if you're looking at the debt that he took and you're looking at the terms in which they negotiated, where interest rates were then, where they are now, that debt is going to be a huge problem for Twitter and for him specifically, given what he wants to do with the company, less reliance on advertisers. Advertisers are leaving. He wants to go to subscription models. There's no reason to believe that users are going to kind of buy into that. Revenues are going to be much less. He's cutting costs fairly dramatically there. Now, again, I'm talking about Twitter. But you and I wanted to start out talking about something you touch, your beautiful Tesla car, your investment in the company, which you did at a very early level. You were a huge believer in the secular move. You were a believer in his ability to do what he did. But now all of a sudden, when you think about Tesla below $200, down from this is $400 last year, I got to think that this company, again, it was not going to be immune to all the issues that its tech peers were, but he's making it worse. And his huge challenge that he's taken on with Twitter makes absolutely no sense. If you are a Tesla diehard here and you're in it, you're in the Tesla story. If anything, it is like an anchor around your neck as a Tesla shareholder. Now, I'm just curious thoughts on that, because it's a big unholy mess.
I violently agree.
Yeah.
I mean,
well, you agreed then.
This is terrible. Yeah. This is absolutely terrible. And, we're supposed to, we're not doctors. So we're not even held to the Goldwater rule. We're not going to diagnose him. We don't know what his issues are. Yeah. But this really, this is a man who has done some truly remarkable things, changed industries. He's, arguably, Twitter stuff, even before the Twitter stuff, this is a guy, arguably the single most important non-country leader in the world. I would argue that. And this, I know the lawsuit is going on right now over his compensation. Yeah. When they announced that, you look at the numbers, and if you're a Tesla bull, you think he really can increase the market cap by tenfold. And you knew that he was going to make, $50 billion if that happened. And you said, cool, if I can get a 10-bagger, I'm happy with Elon. Yeah, Elon, I don't care what they pay Elon, right? So, and you cannot argue that whatever Tesla's market cap is, Elon is, enormously responsible for. I think we've had this conversation before about Tim Cook has generated a hell of a lot more market cap than Steve Jobs did. He's done a great job, but he wasn't the founder. No question that electric cars are a secular theme, right? Got a lot of pushback from that, even last year before. And then it became, it's a secular theme, but Ford's going to kill him with the Mustang, or, there's a new EQ series from Mercedes, or what about Rivian and Lucid? I think it's pretty clear who the industry leader is. And I think it's pretty clear that that electric cars, which are, probably still less than 5% of the car market, are going to take over the entire industry at some point. Great. It's not a competitive issue. It's not a demand issue. It has been a supply issue for the company. What they've really been focusing on for the last year is getting these two new factories in Germany and Texas ramping. It doesn't, there were people thinking they were going to ship 250,000 units out of each factory in 2022. Okay, they're not going to come close to that. So what Tesla needs to do is build more cars, deliver more cars, and service more cars. It may not be that exciting, but it's what they need to do. And they're doing a robot thing, and they're still working on autonomous driving. What they have to do is build more cars. Do I like it? Oh, and by the way, the CEO has this other little venture that, forget going to Mars, the entire future of the company depends on the rocket that they have wanted to ship. They wanted to have the first true demo of, for the last year. It's supposed to be in December. I don't know if it gets pushed out again. I don't know how. And I own, we own a fair bit of SpaceX privately. kind of wish he was paying attention there too.
So as a shareholder of SpaceX, and again, I think you could probably reliably think that at some point in the not so distant future, SpaceX will have $1 trillion market value, and whether it be still in the private markets, because maybe it can, but if it ever goes public, if you thought Tesla was a mania, SpaceX will be an absolute mania. And I guess the thing I would just say about Tesla really quickly is that you talked about Giga Germany and Austin. Okay. Well, here's the deal. He's never really had to deal with a demand issue because of the secular shift. And you talk about competition. Well, think about Germany. Those Mercedes, those Porsches, those Audis, those are hot cars. So on the high end, everybody who is inclined to buy a $130,000 sedan, okay, is definitely going to look at one of those cars as a competitor to a Model S, in my opinion. Okay?
He ceded a lot of market share in the $100,000.
Yes, and they're focused on the lower end. Okay. Now, I spend a lot of time.
I think the Model Y was the number one seller in Germany in the last quarter.
But here's the thing. I'll just tell you this, Dan. I every time I have the opportunity in as far as Uber or Lyft, okay, to take one of those lower end ones, I do, because I just want to feel how shitty they are. They are not great cars. And I know car people, the lower end ones, they feel like they're rickety. I always ask the Uber drivers what they think about them. They're just happy that they're not paying for gas. And that's purely anecdotal. I get it. So my issue is that I think they will have a demand issue. Okay, I think they're going to have a demand issue in China. I think they're going to have a demand issue in Europe. I think that Ford and GM are serious as hell about competing with them on the mid to lower end. Then you say to yourself, you just told me you wish he was not tweeting all day, essentially. You wish he was not dealing with the culture wars. You wish he was not going on Twitter encouraging his 115 million followers to vote for Republican Congress people. Okay, so all of those wrapped up. And here's the other thing I'll just say about Twitter. Jack Dorsey, who co-founded the company, was running it into the ground, which is very clear over the last year. Okay, he was running it into the ground as the co-CEO of two companies. So this guy is out now. Musk today in a Reuters article. I don't know what they're quoting.
120 hours a week.
Yeah, he's going to burn out.
Well, we've thought that before.
Well, he's not a robot. He's
not a robot.
A man.
He tends to focus on, he's got a lot of things going on. He's got the Boring Company too, and Neuralink and whatever. He does tend to focus on one of the things pretty passionately. I used to have a bunch of executives who I was close to at Tesla that are, for the most part, gone. But I do remember talking to a very, very senior guy who said that during the Model 3, right? Remember the Model 3 manufacturing problem? They loved the days that Elon didn't come into the office because they got a lot more done. So this is our opportunity to see what Tesla does when Elon's not paying attention as much. What I worry about is the brand. Do you look at Tesla and think of it as an extension of Elon or not? I don't know. Right? I do because I've been doing it for so long. But do new car buyers think, I don't want to buy a car from,
I wouldn't buy a car from him.
From Elon
I don't want to be on
right?
Twitter because one thing I'll just say is that, there's going to come a time, and I know that you've used this expression, the Elon halo effect on the valuation and that sort of thing. The stock's going to be low enough, and in my opinion, and I don't have a position, I was short a bit this year, it's going to go low enough where the day that he leaves, whether he's ousted, stock goes up. I'm just telling you, it's going to happen. And it used to be the opposite. It used to be that 20% it would have been an air pocket lower. You know what I mean? And so,
what's the market cap now?
It's $600 billion,
I think there's still an Elon halo.
Yeah. But listen, I'm just telling you.
So that time has not happened yet.
I think it's literally one of the worst stock charts in the entire market. I really do. It is a massive head and shoulders formation over the last 2.5 years. November 2020, the stock was just below, I think, $150. S&P announced it was going into the S&P 500. It literally doubled. And then it doubled in the next month or so. I think it's going to probably round trip to that 150 or so. And then there's going to be tons of shareholder lawsuits. Listen, a lot of our listeners are getting sick of me ranting about this. I don't care. I'm not talking my book. I'm just telling you in my 25 years in this business, and make no mistake about it, we were in a huge asset bubble in the last couple of years. Never have I seen the poster child for asset bubbles or the poster child for...
I hear
you disagree with that?
Guys talk about it that way. It's the best secular growth story
At the worst valuation.
Whatever. It's the best secular growth story in the market that I know of. Okay, this company is growing at 50.
So you're
this
long,
company
are you
is
still long
growing
Tesla?
at 50%. This company has a supply problem.
Does it though? Because I thought those delivery numbers and the channel, like this is
They
kind
have
of
said that every quarter. They always have this big push at the end of the quarter, and every quarter they say it's going to be the last time we do this, but they produce more cars than they expect to. What happens to Tesla if they beat the December quarter?
Well, I mean, shorts are going to have to cover it. But do you think there's a scenario, though, where this company, again, going back to, like, I'm looking at, revenue growth expectations. They're going from, 55% this year to 40% next year to 23% in 2024. And if to compete with the infrastructure that, like, let's say the Germans or the Japanese or the Koreans or Detroit have, if expenses start going up and those margins start coming in, then it becomes just another car company.
There is a time where Tesla is a car company if nothing else happens, right? If autonomous doesn't happen, and I'm not a big fan of autonomous, if Optimus doesn't happen, I don't know what to think about Optimus. If solar doesn't happen, I don't know what to think about that either. But yes, there is a point where Tesla's a car company. Now, does the industry, this is some of the, crazier analysts talk, do we end up with cars as a service, right? Does the whole model change and they lead with fleets and they're competing with Uber? I don't know. You are 100% right. Absent new things, they are a car company, maybe the most profitable car company in the industry. They have the highest margins in the industry. They may be the low-cost producer in the industry. I think that you can certainly make that argument. When the CEO of VW says we can't compete with that factory, that's telling you something. How many years did I hear about how IBM was going to kill every PC company because when they put their full weight behind it, oh my God, they knew how to make mainframes. The companies you all named are really good at developing internal combustion engine cars that they sell and service through dealers.
Yeah, it's a different model. Yeah,
it's a different model.
And again, you can make he's increased adoption of this, of EVs, and he's pushed it forward. He's pushed all the others to do it. If nothing else, if that's his legacy, I'm just saying, if he kind of wrapped it up and turned in the keys to Fremont or wherever he is now in Austin, it would be an amazing feat.
The mission of the company was to accelerate the move towards.
I just question his again. I just question him. Again, we can't diagnose him. No, but my point is he's taking on such big things.
I know.
And Twitter is not the thing he thinks it is. And SpaceX clearly is. And EVs clearly is. I just think he's full of shit. And I, again, you know what? My New Year's resolution in 2023 is going to be to stop ranting about it. And
how many human beings who are not country leaders are above the fold in the New York Times, Washington Post, and Wall Street Journal every single day?
That makes him very dangerous.
100%. I agree 100%.
I've been saying I think he's one of the most dangerous people on the planet. The fact that he thinks the fact that he thinks that he can talk to Putin or his people and try to negotiate, through Kremlin talking points. The fact that he embraces free speech, but he actually has to embrace the Chinese, the most authoritarian regime in the world, because he needs the growth and he needs the manufacturing over there. So I think he's just a massive hypocrite. I think he's full of shit. I think he's dangerous.
One last comment. With Tesla and with SpaceX, he is a chess player who is thought 20 moves ahead. And he's done a better job than the rest of us he's been right. With Twitter, it feels like he's thinking one day ahead, one move ahead.
No, I agree. I mean, I think he's in a bit of an echo chamber. I think guys like him don't really have friends. And I think a lot of people have kind of worked him into a situation that really could be the downfall of his. I think this is like his next computer phase. I really do. If you want to equate it to Steve Jobs or so.
It worked out for Steve.
It worked out for Steve, but I think he was probably in a very low point. If you read any of those biographies, he was not the Steve Jobs that he was in the 70s and early 80s, or again in the late 90s into the 2000s. 2000s, and it was probably a really dark period for him. And I think that's probably where he's going, sadly. So listen, Dan Benton, you are one of the most brilliant market minds that I know. I've really enjoyed over the last, I want to say 6 or 7 years, becoming friends. Can I call you friend? And I love having you on here. I hope you come back every quarter and give us your download on what's going on in tech and in the markets. So thank you very much for joining us.
Thanks for having me, Dan.
Thanks again to our presenting sponsor, Current, and our supporters, Masterworks and Taboola, for bringing you this episode of OK Computer. If you like what you heard, make sure you hit follow and leave us a review. It helps people find our show. And we want to hear from you. Email us at contact@riskreversal.com. Follow and connect with us on Twitter @OKComputerPod. We'll see you next time.